on a cold morning in January 2021. A nearly forgotten video game store became the most powerful stock on earth. Hedge funds bled billions, trading apps froze, and millions of small investors watched their phone screens like heart monitors in a financial war. This is the story of how the internet challenged Wall Street and what happened when the market pushed back. GameStop began as a simple retail chain selling physical video games in shopping malls across America. For years, it thrived on trade dens and disc sales, but the world was changing. Digital downloads, online shopping, and new consoles threatened its business model. By 2019, GameStop was shrinking, closing stores, and losing revenue. On the other side of the market stood hedge funds, large investment firms that profit not only when stocks rise, but also when they fall. Their weapon was short selling, borrowing shares, selling them, and hoping to buy them back later at a lower price. If the company collapses, the short seller wins. By 2020, GameStop had become one of the most heavily shorted stocks in the U.S. market. While Wall Street bet against GameStop, a different conversation was happening online. On a Reddit forum called Wall Street Bets, users analyzed the stock and noticed something unusual. More shares of GameStop were shorted than actually existed in the market. This created a dangerous setup called a short squeeze. If the stock price started to rise, short sellers would be forced to buy shares to close their positions. That buying would push the price even higher, and higher prices would force even more buying. In mid-2020, GameStop shares traded below $5. By January 2021, they crossed 50, then 100, then 200. Millions of retail investors flooded in, using apps like Robinhood, turning stock trading into a global live stream event. GameStop was no longer a company. It was a symbol. As the price climbed, hedge funds began losing massive amounts of money. One fund, Melvin Capital, reportedly lost more than half of its value in weeks and required a multi-billion-dollar emergency investment to survive. Behind the scenes, pressure was building in the financial system. When stocks surge, brokers must provide more collateral to clearinghouses to guarantee trades. The higher the price, the more cash they must hold. For trading platforms, this created a liquidity crisis. The system designed to keep markets stable was being stretched in real time by millions of small traders acting together. On January 28, 2021, everything changed. Robinhood and several other platforms suddenly restricted the ability to buy GameStop shares. Users could only sell. The impact was immediate. The price collapsed within hours. Online, anger exploded. Politicians demanded hearings. Regulators opened investigations. Accusations flew between hedge funds, brokers, and trading apps. The market had become a courtroom. In the following days, GameStop's price swung wildly, moving hundreds of dollars in both directions. Fortunes were made. Fortunes were erased. By February, the mania faded. GameStop shares stabilized far below their peak, though still higher than before the surge. Some early retail investors walked away with life-changing gains. Many others entered at the top and suffered heavy losses. Hedge funds adjusted their strategies, reducing public short positions. Trading platforms changed their risk models. Lawmakers debated market transparency, payment for order flow, and the power of social media in finance. The event became a case study in modern markets, where information moves at the speed of memes and collective action can move billions of dollars in minutes. GameStop was not just a stock. Teach was a collision between old finance and digital crowds. Huge between algorithms and emotions, between institutions and individuals. For a brief moment, a message board shook the foundations of Wall Street, and the market learned a new lesson. In the age of the internet, power can go viral.